Good morning, everybody. Happy Halloween. Let's take a look at how things are going and how things went since the last time we spoke about a month ago. So I'll dive right into kind of the chart, the overall market. On the screen here, you'll see the chart that we've been looking at for the past few months. Overall S&P 500. So last month we were looking right about here. So the market was approaching kind of a heavy support level. So there was trend line support that you can see by the red line. There was moving average support, which is the blue line. So both those things by themselves typically provide some fairly strong support. Together, they provide even more. So we were pretty confident that the market was going to bounce off this area, which it did. Kind of right on cue, got to these two support levels, bounced off. That was somewhat expected. Moved up for a few days. What was unexpected is when the market stalls out, kind of right in the middle of everything, pretty sharply, and then also turns and moves downward pretty sharply. We didn't see that coming, or I mean that was more of a surprise than the bounce right here. The main reason that it happened is interest rates. Interest rates on the 10-year yield have been rising steadily, and the market just kind of got to the point where it was just too much. The market doesn't like rising interest rates. So at this point, got to the point where the 10-year yield was reaching 5%, which is the highest it's been in a long time. It was just too much for the market to handle, started selling off. Which was a surprise because the start of earnings season started about a week and a half ago or so, and corporate earnings have been good for the fourth quarter based on the third quarter. They've been solid. They haven't been great, but they definitely have not been terrible. Where it would generate a big 7% or so market sell-off in 2 weeks. So market sentiment got really negative really quickly. Even good earnings, all the big mega cap stocks that came out with pretty good earnings, they all sold off into it. So when that happens, it's just like, listen, sometimes the market just wants to go down. Sometimes the market just wants to go up no matter what too. So it moves both ways. We're just kind of in a point right now where the market just kind of wants to go down for a while. So, question is kind of where do we go from here? We're finding some stability right around here for the past couple days. So that's good. My thoughts are not that we're on the precipice of some huge downturn in the market. There's the fundamentals and just the market setup are too strong for that to happen, I think anyway. More likely the market kind of chops around and finds some footing somewhere around here. We broke through the moving average and the trend line pretty sharply here. So when that happens, the market, the chart just kind of breaks down a little bit. And the best solution or fix for that is just kind of time. Like the market just needs a little bit of time to regroup, find some footing, and start to move back higher. So that's kind of where we're at right now. Chart doesn't look great, but it's nothing catastrophic that we got to really worry about. All right, the second thing I wanted to cover today was an update on how we're managing the more defensive or conservative sides of our portfolios. So in every portfolio, there's an aggressive side, there's a more defensive side. Some of you only have the aggressive side. If our goal is to be aggressive in the market, we don't necessarily need a defensive side, but the majority of you have both because the defensive side is used to reduce the volatility of the overall aggressiveness of typically an individual stock portfolio. But the question is, how do we accomplish that defensive side of the portfolio? Historically, in portfolio design, you would use either bonds, typically be bonds, to do that. We have not really used bonds just because they've not performed well. In fact, last year, bonds lost almost as much money as stocks did, so that's not good. It's not good when your defensive side loses almost as much as your aggressive side. This year, bonds are down also when the aggressive side's doing better this year. So, historically, bonds have not been a great, recently, bonds have not been a good place to have more of the defensive side of the portfolio. We've historically used more defensive stocks like consumer staples and utilities and the more kind of just defensive, lower volatility sectors out there. That works better. Last year, they lost far less money than the more aggressive side of the market. This year, though, they're lagging. In fact, this year, the only stocks that are really doing well are more of the kind of the larger growth tech stocks. The majority of the market actually isn't doing that well, but the indexes are being held up a little bit by just the big tech stocks doing well. So we've been working on an option to, kind of have the best of both worlds somewhat, where if the market's bad, it's far more effectively defensive, and if the market's good, we still participate in the majority of the upside. So we have that. We launched that a couple weeks ago. I'll kind of explain how it works, and then talk about just an opportunity that's available kind of right now with where the market is. But the way generally the accounts work is they're created with ETFs, exchange traded funds, and then internally inside the exchange traded funds, the strategy uses options to provide some downside protection in the overall portfolio. So typically there's about a 15% downside protection, or what we call buffer, which means that if the market's down 15%, that model will not have an effect negatively on the value, or it's not going to lose any money if the market's down 15%. If the market's down 20%, the model will lose 5%. So that first 15% of downside loss in the overall market or the index, which is the S&P, is protected by the options strategy within the ETF portfolio. In exchange for that, there's an upside cap on the potential upside in the market. And both these time frames are over a year. So the market's down 15% over a year. Also, there's usually about a 15 or so % upside cap throughout the year also. So if the market's up 10%, we get 10%. Market's up 15%, we get 15%. Market's up 20%, we get 15%. So in exchange for a lot of downside protection, there's an upside cap. This is the way the strategy works. So it's really, again, it's not meant to, be super aggressive and maximize gains on the upside, but it's meant to be a good proxy for that defensive part of the portfolio where it protects the downside far better than bonds or the defensive sectors of the market, because the first 15% is no loss. But it also has a far better upside than bonds would. Bonds up 15% is incredibly unlikely. The defensive sectors of the market, utilities and staples, up 15%, also not super likely. So it does give us a bit of the best of both worlds. Better upside protection, way better downside protection. So we deployed this strategy into the defensive sides of our portfolio a couple weeks ago. So if you have, for example, flagship core, which is a very common model for a lot of our clients, that model is 80% aggressive, 20% defensive. So if you have that model, 20% of your portfolio is in a downside protected strategy right now. There are other variations of this strategy, one of them being a similar setup, but the first 5% of the downside of the portfolio we experience, but then the next 30 we don't. So with that model, we're trading off a little bit of upside or a little bit of downside loss right away for a much bigger chunk of downside loss after that. That model still also has about a 15% or so cap on the upside. The opportunity is when that model launches, and this version of it happened to launch back in August, the market is already down 5% since then. But we don't have to get in right away. So we can actually rebalance into that model now, skip the first 5% of losses that we would have experienced or that people that were in on day one have experienced, but only get the benefit of the next 30% downside loss protection. So right now, we would essentially start with about a 30% kind of downside buffer right off the bat, which is awesome. The second part of that, though, is the original cap was 15%, but the market's down 5% since then. So now the cap is making that 5% back and the 15% original cap. So right now, rebalancing to that model, we'd have a 30% downside kind of protection or buffer along with a 20% upside cap, not 15. So the market just happened to move in a way that makes this possible. If the market goes back up soon, then that opportunity will kind of go away because it all depends on where the index is trading at. But as of today, as of Halloween, it's about right at that break even where it's down 5% since the original launch, so we can get in with essentially immediate downside protection for 30%. So we rebalanced our defensive side of the model into that actually a couple days ago. So now everyone, whatever your defensive kind of portion of your portfolio is, has a 30% downside buffer as well as a 20% upside cap. I'm doing the video and explaining this to you because we can do more of it, of your portfolio into that strategy if you want to. So if over the next 12 months you're not confident in the market, or you just don't want to take as much risk in the market, all you have to do is let us know and we can rebalance more of your portfolio into the more protected model where it's got a lot of downside protection but still a pretty good upside potential as well. So if it sounds like something you want to know more about, all the numbers I've talked about today are very kind of general. The numbers change with the market every minute. It's a little bit different. So if it's something that sounds interesting, shoot me an email. Respond to this email. Let me know you're interested and want to talk more about it. We can get together. I'll go over the exact numbers with you, see if it might be a good fit, and we can go from there. So that's what we're up to this month. If I don't hear from you, we'll talk again in a month or so. But hope everyone's doing well, and we'll talk to you soon. Take care.